What if you could get 15 to 20% income every year from your retirement investment instead of the typical assumption of 4%? Some funds promise exactly that, and they're becoming increasingly popular with retirees. So in this video, we'll break down how these high-yield funds actually work and whether they could be the right choice for your retirement strategy. Today's video is sponsored by Trading 212, a UK commission-free investment platform. Now, the usual assumption in retirement is that you can withdraw about 4% sustainably in order to keep the size of your investment pot the same. So in real terms, the size of your investment pot shouldn't shrink too much if you withdraw 4% per year. Now, what that means is if you want an income from your investments of £30,000 a year, you'd have to save £750,000 in total. But what if, and this is a big if, what if your investment pot could actually generate 15% instead of 4%? Well, then you wouldn't have to save so much money. In fact, you'd only have to save £200,000 to generate that income. So if it was the case that you could sustainably withdraw 15% per year from your investments, then that would mean you'd have to save a lot less. So that's the motivation behind this video. Let's look at whether there are funds which could generate that kind of income, but also how they could generate it. So how do these funds work? How do they generate so much income? Well, under the hood, there's some financial engineering. And this financial engineering converts volatility, which is the daily fluctuations in the price of any investment, it converts that volatility into income. So the amount of income you receive depends on the volatility of the underlying investment. The more volatile it is, the bigger your income. So here, for example, you can see three of these yield-enhanced funds. The one at the top is a global index fund, which, as you'd imagine, because it's very diversified, is not very volatile. And the dividend yield there is just under 8%. Dividend yield, remember, is the amount of income over the last 12 months divided by the price of the fund today. The middle fund buys the S&P 500 index, which is just one country, and usually that's more volatile. So there the dividend yield is just over 10% at the moment. And the bottom fund uses the Nasdaq index, which is very much growth-oriented and tends to be more volatile. And there the dividend income is over 12% per year at the moment. Now you can go even further. If it is the case you can convert volatility into income, why not choose single stocks or commodities? And an asset manager called Income Shares is offering precisely that. And here you can see a selection of their funds. Notice that some of them are commodities. You can do it for gold and silver. There's also the choice of some single stocks like Palantir, which is currently offering a dividend yield of just under 60%. Now, of course, that comes with its own risks, and we'll talk about those in a moment. Now, some option strategies generate more income than others, and here, for example, by selling short-term put options on the Nasdaq 100 index, you can see that that's generated over 100% dividend yield as I make this video. And that, of course, is an average over the period from January to July. So now let's dig into the financial engineering behind these products. These are option selling strategies. If you sell an option, it's priced according to the volatility of the thing which it's linked to. So for example, a very volatile index like the Nasdaq 100 will generate more income than the S&P 500. So the idea is you buy the underlying thing, let's say it's a stock, at the same time you sell the upside to somebody else, but of course you're not actually able to participate in that upside. So that's the drawback of these strategies. Your upside is capped and you keep all of the downside. Why would you ever do that? Well, it means that you can pocket the premium for the option today. So what this is doing is every month, say, selling the upside to somebody else and pocketing the income as a result of that sale. In order to deepen your understanding of how these strategies work, I think it's useful to compare two different things. Either we buy the S&P 500 with an index fund, say, and the P&L, the profit and loss of doing that, is shown as a red line on this graph, or we do one of these yield enhancement strategies, which is also called a buy right strategy. because you're buying the S&P 500 and writing or selling a call option on the S&P 500. So the buy right strategy, or equivalently the covered call strategy, is shown in green. Notice how you've kept all of the downside and you've capped your upside, and that's the strike of the option. But notice that the green line is shifted upwards relative to the red line of simply buying the S&P 500, and the size of that uplift is the option premium. But for all of the downside, you're better off with the option premium because of that income. But on the upside, the drawback is that if there is a huge rally, then you're not going to participate in it. Now, before we look at the risks of these strategies, but also situations where they might be very useful, I'd like to talk about Trading 212's ISA. And today's video is sponsored by Trading 212. I've been using Trading 212 Stocks and Shares ISA for a few years now, and I absolutely love it. Here's why. Firstly, it charges no account fees or any monthly or annual subscription fees. Secondly, it offers lots of choice for my fund portfolio, which is what I have on Trading 212. Trading 212 offers over 13,000 ETFs and stocks from the UK, US and Canada and Europe. And finally, it leads the way with new functionality all the time. For example, it offers fractional shares, pies and auto investment. And if I had to choose my favorite feature, it would probably be pies, where you can create portfolios within your ISA. If I want to rebalance one of my pies, I can do it with just one click. And you can fund your pie automatically, and that encourages regular saving. You can also reinvest any dividends back into the pie automatically. And if you're scratching your head deciding what to include in your pie, there are lots of popular portfolios and even portfolios created by professional fund managers. Furthermore, Trading 212 charges no account fees whatsoever on their stocks and shares ISA. Their ISAs are flexible, which means that within a tax year you can withdraw cash and put it back into the account without affecting your ISA allowance. Your money's kept in a segregated account and protected by the Financial Services Compensation Scheme up to a value of £85,000. Now, as a viewer of PensionCraft, you get a special offer from Trading 212 where you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is RAMIN, RAMIN, and you'll find a link to that offer in the description below. So now let's think about the risks that come with these covered call strategies. Now previously we saw the payoff graph for one of these buy right strategies where you've capped your upside, and that immediately tells you the kind of environment in which it'll do well and outperform simply buying the underlying index. So for example, if we've got a range-bound market where we're just bouncing around in a certain range without a strong rally, well, in that kind of environment, the income from the selling of the option will be to your benefit. So you will outperform just buying the underlying index. However, if you do get really rapid rises in the index, and that could be a post-crash rally in which you don't participate, or it could just be a steady upward trend, which is very strong. In that kind of environment, you'll be unhappy because it means that you're not going to participate in those rallies. I think another huge risk with these funds is to do with inflation. Now, historically, equity markets have been great at beating inflation. They have that steady upward drift, which has tended to be about 5 or 6% above inflation over the last century. However, because of the payoff of these covered call strategies, you're not going to participate in a lot of those rallies. So what you might expect to see is that after a big equity market crash, when you usually get a big bounce back in the equity market, you won't participate in that. Plus, a steady and strong upward movement of the index, again, means that you won't participate. So gradually over time, this is going to erode the value of your fund. So let's look at the income stream generated by one of these US covered call funds, QYLD, which sells options on the Nasdaq 100. Now in nominal terms, you can see that it's generated a fairly steady income. It does vary over time according to the volatility of the index, but it has remained fairly steady. It's usually been in the range of about $1.75 up to about $2.75. But that's in nominal terms. That's before we look at the effect of inflation. If we factor in inflation and look at the real income, notice how it's fallen quite dramatically, about 30% after the recent bout of inflation. So that's a huge threat if you hold these strategies long term. Somehow you've got to generate capital gain to beat inflation. So in their purest form and on their own, these strategies can't achieve that. And I'd also be really careful about the single stock covered call funds. Yes, they generate huge dividend yields, particularly for really volatile tech stocks like Tesla, but notice what happened to this covered call fund for Tesla here, TSLD. It's fallen 40% over the course of this year, and it simply hasn't recovered, even though there have been strong rallies in Tesla itself. So if you are going to buy these single stock yield enhanced funds, then make sure you don't just buy one or two of them, diversify across multiple ones. Or alternatively, avoid them altogether. Now it's worth remembering the benefits of a simple stock and bond portfolio. Now it's worthwhile remembering why these strategies are good. You have to be patient, of course, which isn't a virtue which we'll share, but they do work long term, particularly if you have a large amount of equity in your portfolio. And by work, I mean they beat inflation. These are the inflation adjusted returns for all 5 UK life strategy funds. And even in the worst case, which is Life Strategy 20, it's beaten inflation by 1% a year. Life Strategy 100 has beaten it by over 7% per year on average. So if you are willing to be patient, these strategies work. And you don't need to go to some fancy financial engineering in order to craft a good retirement. So I'd say that for the core of your portfolio, these funds and the strategy of mixing bonds and equity works very well indeed. It's only certain niche applications where covered call strategies would work quite well. So these traditional strategies are better than a yield enhanced approach in my opinion because they're simple. Many people understand them. You know what you get when you buy stocks and when you buy bonds. And as always, don't buy something you don't understand. Secondly, you participate in the entire upside because you own the underlying stocks and bonds. That means that when there is the inevitable rebound after a crash, you get that rebound straight into your portfolio. And then finally, as we've seen, it's unlikely that you're going to get your portfolio eroded by the pernicious effects of inflation. Now in investment, as in life, it's always good to have a sense of balance. So as the core of your investments, I think one of these yield enhanced strategies wouldn't make sense. But if you mix it with a global index fund, you can ensure that the size of your overall pot doesn't shrink over time in real terms. How much equity do you need to mix with it? It depends on how large the negative return is in real terms for your covered call fund. Here's how much equity you'd need depending on what the negative real return is of your covered call fund. So let's assume that the covered call fund falls by about 5% per year in real terms. And that's because of the upside you've given away. Well, in that case, a 50% equity allocation would balance the loss, the capital loss, due to the covered call fund. So by mixing the two together, you might come up with a portfolio which achieves your goals. Or instead of having to mix together an equity fund and a yield enhanced fund yourself, you can also go for these funds which I've seen in the US, which don't sell all of the upside. Here, for example, QYLG is the same as QYLD in the sense that it sells some of the upside, but it only sells 50%. The remaining 50% gives you exposure to the Nasdaq 100. So the cost of that is a lower yield, just around 6% at the moment, rather than 12% for QYLD. But maybe that's the balance you want. And it could help overcome this problem of erosion of capital value in real terms. So if I plot the price of QYLG, which is the growthy lower income one, QYLD, which is a high income low growth one, and QQQ, which simply tracks the Nasdaq 100, you can see that the capital loss for QYLG has been much lower, whereas QYLD is down 20% since September 2020, largely because it hasn't participated in rebounds. QYLG has participated, at least partially, in those rebounds. And there are some of these blended yield-enhanced funds which are available to UK investors. Here are 3 of them from JP Morgan, and this is from their equity premium income funds. Now these are all active funds. The fees aren't particularly high, 0.35% for these 3, but you can see that they have option writing strategies which vary between the funds. JEGP sells out of the money index options on MSCI World, the developed market index. JEIP sells single equity options or index options, as does JEQP. Now those single stock options which are sold are chosen very carefully, just as the stocks which are chosen to go long in these funds. So that's the basis of research from the equity desk at JP Morgan. So if they choose the right stocks to sell the upside for, then you could still participate in the upside if they choose the right stocks to go long. So this does require stock selection to be accurate to some extent, but I think this kind of approach that mixes yield enhancement with buying the underlying index may be the way forward in future. In summary then, I think these strategies are very tempting. Everyone wants a yield of over 20%, of course, and that would mean that they'd have to save much less in their investment pot. But don't forget what you're foregoing there is long-term the ability to beat inflation. However, if you do need income over a short period of time, maybe you're taking a gap year, or perhaps you're doing a sabbatical where you need income over a fairly short period of time, well, these kind of strategies might make sense. Or perhaps as part of your general investment account, if you're a basic rate taxpayer, then the capital gains tax you have to pay is going to be higher than you'd have to pay with income. That's not true for high rate taxpayers at the moment in the UK. But for those people, I think this kind of strategy in a GIA might make sense. Or perhaps in that period between when you retire and when your state pension kicks in, this could be a good way of generating income and filling that gap. But if you are going to be using this strategy long term, just be careful because of that capital erosion effect. Now don't forget the offer from the sponsor of today's video, which is Trading 212. If you want to claim free fractional shares worth up to £100, just open an account, verify it, fund it, use my name as the promo code, which is Ramin, R-A-M-I-N, and you'll find a link to that offer in the description below. And, as always, thank you for listening.